Glenn, let's talk about the economy. Let's talk about the election.
Okay.
Where do things stand on both from your perspective?
You know, I'm a little bit nervous here this morning, Becky, because the problem I have here is that the economy might just be too good, and it frightens a contrarian like me. If you look at the IMF report that came out yesterday, and they talked about how the U.S. has the best economy among the developed countries. It's the second increase in the year in the forecast for U.S. economic growth. The gap that's being created between us and the G7 countries, led by investments, both public, coming out of things like the CHIPS Act and green energy, plus the amassing of private capital, led by AI, but lots of other things going on. It really, for a contrarian like me, that's a nervous time, if you know what I mean.
Yeah.
Warsh said it was all the stimulus. Did you see him? He was just.
I saw a little bit.
He said it was totally juiced by the Fed. It's not really organic or any of the things you.
Well, I don't know if it's juiced by the Fed.
That's what he said. And fiscal authority. And the fiscal authority.
Yeah.
Well, they're one in the partners in crime.
A lot of the extra spending, too. By keeping rates at zero for so long, he said it enabled fiscal spending.
Well, I think that's a good point. I mean, I'm talking about the current economy. He's talking about a more broader sweep of things. So if you want to go to that for a minute, I think one of the interesting things that's happened over the course of this past interest rate cycle is how well the economy has tolerated high interest rates. Fed policy across administrations, across Republican and Democratic sort of chairs, has, since 9/11, has basically taken the view that you had to bring interest rates down close to zero in order to stimulate economic activity in periods of crisis.
And we've had a lot of crises since.
And we've had a fair amount of crises.
You remember the 80s and 90s, how great the economy was, and we were at 8 and 9%.
And that's exactly right. I agree with that, Joe. I mean, if you look at what's happened over the last.
It's weird. It's like a new normal.
Well, I don't know if it's weird or not. It's interesting. So I've been wondering about it, but.
And you're a Fed guy. You're a big Fed watcher.
Yeah,
former Federal Reserve.
I had the great privilege of being associated with them for 10 years.
Right.
It turns out that higher interest rates allocate capital in a more healthy manner.
Yeah.
And that what happens.
So much for that.
Yeah.
Now we're going back down.
Well, but we're still pretty reasonably high interest rates, right? I mean, everybody's talking about this new, this Fed speak, this new neutral rate is going to be, something closer to 4 or 5%. But it turns out that all the stuff that gets funded when money is free, both government spending, because you take the view that, well, interest rates are so low we can spend, or investment spending, because the business case is for mediocre investments is made possible by low interest rates. It turns out neither to be very healthy.
Right.
And so having a positive price for capital probably is a healthier place to be in our economy. That's, I think, point one. And point two is that it all comes back in the end to what entrepreneurs do and business people in terms of investing in and building companies. And the incredible, I think what we're finally seeing right now is productivity, the investment-led productivity coming through and driving a lot of the growth that the United States, and that's what mainly distinguishes the United States from Europe. I mean, Europe had, we talk about who caused inflation, but it turns out that Europe had about the same inflation that the United States did. So it's not, so the global inflation doesn't really vary that much. I'm not sure.
Europe, some areas had a little higher.
A little bit higher, but not over that sustained time period. But what's most distinguished at that time period is the much higher growth of the U.S. economy.
Right.
As a result of our investment, our productivity, and entrepreneurship, that kind of thing.
Is that at risk or is that safe? Because we have a lot of people who come in and question whether we're going to do things that chip away at that, particularly as we try and deal with bigger and bigger deficits.
Well, no, look, I think, okay, so the next thing we have, I've said last time I was here, I think the next thing we have to deal with is cutting spending, increasing taxes, balancing the budget over a long time period, like the team that I was a part of in the White House did in the early 90s. And from the point of view of how that affects private sector activity, to actually have the government in the marketplace for less borrowing turns out to be there's a phenomenon called crowding out, where the federal government can actually crowd out the private sector access to capital. And so I think it's actually better for the overall economy for there to be less borrowing by the federal government. And while there is some stimulus that you get from to near-term growth from cutting taxes or stimulating the economy generally, all you're doing is borrowing that from the future. You're just taking that from the future and bringing it into
crowding out is like no one talks about it anymore. It's like because of MMT, I think.
I don't know. It's just I think because of low interest rates. But you talk to people who are running the big financial institutions in this town, and we don't want to get too technical here, but they're talking about weak bid to cover ratios, and kind of some minor issues here and there in the financing markets. And the last thing, the fear one has is the only time we're really going to get to deal with this fiscal problem is when there's a problem, right? Rather than getting out ahead of it.
Right.
So I think that. But I think we got to get past this election.
When there's a problem, meaning the Treasury markets or investors in the Treasury market say no more type of situation?
Yeah, you can have those sort of, exactly. You could have a spike in interest rates. You could have a little bit of backup in the markets. The sort of things that become a signal of where you're issuing a little too much debt.
Yeah.
I'm not predicting any crisis right now. I'm just saying that I just hope we don't have to get to a crisis to deal with these situations.